Let's talk about something that's on pretty much everyone's mind right now. We are seeing an absolute explosion in AI. I mean, stocks are soaring, there are new breakthroughs practically every single day. But doesn't it all feel just a little familiar? Right? It's the ghost that haunts every single tech boom, that spectacular, unforgettable crash of the dot-com era. So the big question is, are we just watching a rerun? Is history repeating itself, or is this new AI wave built on something fundamentally different? All right, to figure this out, we've got to look back first.
So to really understand if today is different, we have to get into the weeds of what went so wrong back then. What were the actual ingredients that led to that historic collapse?
The late 90s? Man, it was a time of what former Fed Chair Alan Greenspan famously called irrational exuberance. There was this powerful story that a new economy was being born, and the old rules of business just didn't apply anymore. Companies were being valued not on profits or revenue, but on these fuzzy metrics like website clicks and eyeballs. Literally, just how many people looked at their homepage. It was a complete frenzy, and it was fueled by hype, not real-world fundamentals.
But it wasn't just vague hype. There were very specific triggers. For one, you had the Y2K bug. This created this massive non-negotiable deadline that pulled forward years and years of IT spending, which then just fell off a cliff in 2000. On top of that, you had huge fraud cases, like at WorldCom, which created this fake, inflated demand for internet infrastructure. And then you mix in a flood of speculative IPOs from companies with absolutely no clear path to ever making a dime, all happening in a super lightly regulated market that was a magnet for promoters making these wild, unrealistic promises.
And this number? Wow. It really shows you the scale of the problem. At its absolute peak, more than a third, 36% of U.S. tech companies were unprofitable. They were just burning through cash with no sustainable business model anywhere in sight. So keeping that picture in your head, let's fast forward and see how today's AI wave really compares.
Okay, so now we're going to look at the money. Let's dig into the financial underpinnings of the AI boom and see if it's standing on more solid ground than its dot-com predecessor. And right away, the differences are, well, they're pretty stark. The dot-com era was fueled by this IPO frenzy, right? You had small, often debt-ridden companies raising money from the public. Today's AI boom, it's largely being bankrolled by serious private funding and, this is the crucial part, the massive, massive cash flows of the established tech giants. And they have much, much clearer visibility into the actual demand for AI services. Hey, remember that 36% figure for unprofitable companies back in the day? Well, today that number is way lower, sitting at around 20%. Now, it's not zero for sure, but it does point to a much healthier overall ecosystem. But that's not the only difference, not by a long shot. Let's look at the financial muscle behind these companies. The financial power today is just on another level. I mean, unlike the debt-heavy startups of the 90s, today's tech sector has the strongest balance sheets of any industry out there. Giants like Microsoft, Alphabet, Amazon, they're funding this whole AI build-out from their own enormous profits, not just with speculative money from the public markets. And here it is, the valuation reality check. Back in 2000, the tech sector was trading at more than double the valuation of the rest of the market. It was wild. Today, it's much, much lower, at about 1.34 times the broader market. So what this tells us is that this incredible run-up has been driven far more by actual, tangible earnings growth, not just investors being willing to pay more and more for the same dollar of profit. Okay, so the money side looks different. The financials are stronger. But what about the technology itself? The science behind it all. Is the pace and even the structure of innovation telling a different story this time around? This is really cool. By analyzing millions of scientific papers, researchers can actually map out the social network of science itself. You can see who's citing who, how ideas are spreading from one group to another, and what the data shows is pretty wild. The way scientists and researchers collaborated and spread ideas during the dot-com boom was completely different from how they're doing it in the AI era.
So in the years leading up to the dot-com bust, the scientific community was actually breaking up into all these different research clusters, and they were all roughly the same size. It suggests that ideas were spreading out really widely, creating this diverse, decentralized ecosystem for innovation.
Today's AI research network looks fascinatingly different. On one hand, you've got more collaboration happening than ever before. But on the other hand, the whole network is much more spread out, and it actually takes longer for a new idea to travel from one side of the network to the other.
And this creates a risk of scientific echo chambers, where truly new, disruptive ideas might actually have a harder time spreading.
Now, here's where it gets really interesting. How does all this scientific activity actually connect to the stock market? Well, during the dot-com era, scientific collaboration was linked to the VIX, that's the market's fear gauge, basically, but it had no real link to broad market indices like the NASDAQ or the S&P 500. In the AI era we're in now, that relationship is completely flipped on its head.
So what's the big takeaway here? It's this. The actual price movements of major stock indices today are way more influenced by what's happening in scientific labs and research papers than they ever were back in the 90s. It's like the engine room of science is now directly wired into the stock market in a way it has never been before.
Okay, so we have stronger financials, a completely different scientific landscape. What does all this actually mean? Is this a bubble or not? Well, the answer, as it usually is a little more complicated than a simple yes or no.
I think this quote from Microsoft CEO Satya Nadella really gets to the heart of it. He argues that AI is going to become like electricity. It's going to be a utility. So the biggest long-term winners won't necessarily be the companies making the AI, but all the companies in every other industry that figure out how to use this new electricity to better serve their customers.
And that brings us to the new risks, which are a lot more subtle this time around. You've got things like circular financing, where tech giants are investing in the very startups that are also their biggest customers. There's a risk of a hidden bubble, not in public stocks, but in the insane amount of private capital spending, or CapEx, on things like data centers. And unlike the globalizing world of the 90s, today's geopolitical tensions are creating all sorts of new pressures on supply chains and everything else. So the final verdict isn't a simple yes, it's a bubble, or no, it isn't. The evidence really suggests this isn't a repeat of the dot-com bubble. Instead of some spectacular, sudden burst, we're much more likely to see a technology wave that kind of ebbs and flows, with big periods of high returns, but also high volatility as it all evolves. Look, at the end of the day, this AI wave is its own, unique beast. The financial foundations are just stronger. The very structure of its scientific engine is different. The dot-com bust taught us to watch out for hype and unprofitable companies. But maybe, just maybe, the real question this time is whether we're even watching for the right risks at all.